welcome to Galaxy Brains, the weekly podcast from Galaxy Research. I got a mic thirst so big that I flow like my pipes burst. Blind signatures, you don't see how it goes, so disappear forever like Satoshi Nakamoto. Intrepid when I rep it, every second y'all are wrecked. If I said it, then I meant it. Every method is decentralized. Tell the venture guys they need to bench their spies. We keep it open when we're coding, see the tension rise. Let that sink in, feed it out like backwash. The world is teetering on the brink. Shout out to Matt Walsh. Today you can be your own bank, so thank me later. You turn sides against the empire like Darth Vader. Yo, we're playing for keeps, seeking a pristine win. Our guest this week is the inimitable Christine Kim. Ain't never been another man with my number, damn. Yo, I'm smothering every wonderkin that thinks they have a plan. As always, I'm your host, Alex Thorne, head of firm-wide research at Galaxy Digital. Thank you for listening to Galaxy Brains. We have a great show for you today. As I said, we're talking with Christine Kim from Galaxy Research. She's back from Denver in the ETHDenver conference, the biggest Ethereum conference of the year by far. We'll talk to Christine about what her takeaways from the conference were and what to expect from the upcoming upgrades on Ethereum. We'll also check in with our friend Beimnet Abebe from Galaxy Trading to talk markets. Jay Powell, the chairman of the Federal Reserve, speaking before both houses of Congress this week, materially impacting markets. But before we get into all of that, I need to please remind you to look at the link to the disclaimer on the podcast notes and note that none of the information in this podcast constitutes investment advice, an offer, recommendation, or solicitation by Galaxy Digital or any of its affiliates to buy or sell any securities. Yo, this is a good beat. I think we're going to have a good show, so let's get right into it. Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, welcome, my friend.
Thanks for having me.
Yeah, great to have you here. Fun week this week, I should say. Jay Powell himself, the fiduciary of the Fed, the
most important man in markets,
the leader of the Federal Reserve, the chairman of the Federal Reserve. He is testifying in his semi-annual updates to Congress. He did the Senate. Today's Wednesday. He did the Senate Banking Committee on Tuesday, yesterday. I think he may still be, as we record this, speaking now before the House Financial Services Committee. What are we hearing from Mr. Powell?
Well, it was a pretty big sort of hawkish tilt that we had yesterday from his prepared remarks. Basically, he's putting 50 basis point increase for the March FOMC on the table. He's also reiterating higher for longer. And essentially, he gave a huge policy update speech when, the market wasn't really expecting that much. So it was a pretty big deal. We've had a dramatic repricing of front-end interest rates, the dollar, and risk markets more broadly after his comments yesterday. I think they were about as meaningful as an FOMC meeting, a Jackson Hole meeting. It really, kind of took me a little bit by surprise. But I think the overall message is entirely consistent with what they've been saying, which is they're going to be data dependent. And what did we have? We just had a string of hot employment, price, you name it. All the data has been really strong. And so what's the Fed's response function? What's the only thing they can do is jack up front-end interest rates. And now, as we sit here, terminal rates are pricing at around 565 basis points.
Wow.
And 75 basis points for the next two meetings. So some combination of 25 and 50 between the next two meetings. So it's been pretty dramatic. And you've had S&P break 4K, Bitcoin's testing 22K right now. The dollar is broken out. Euro broke 106, dollar yen through 136. And so it's been a very dramatic move.
Yeah, dollar's highest that it's DXY, highest that it's been since November.
Yeah, absolutely. And it's one of those pain trades where a lot of folks were positioned this year to take advantage of dollar weakening, right? As kind of we've, might have had hit peak terminal rates.
Right.
And, the forces abroad were going to lead to more inflation and ECB might have to hike more, et cetera. So the big theme was short dollars going in, and now it's the complete opposite.
Right.
So folks are offsides, don't really have it. And the last thing I'll say about that is, as the dollar is insanely powerful right now, you get paid carry because, rates are at 565.
Yeah.
It's a risk-off hedge. In case the world is like, we got to sell all risk assets, it's going to do well in that environment.
Right.
And so it's a currency that's just got this unique combination of being a hedge, but also being a hedge that pays.
Yeah.
And so it's really, starting to get very compelling just to sit in dollars and just sit in overnight rates or short dated duration.
Goodness gracious. You talked about this interesting these properties and characteristics of the dollar, how it's trading. But so if they raise 50 at the next meeting, they already raised 25, right?
Yeah.
The last meeting.
It's a big shift in policy.
That would be very dramatic, right?
Yes,
and that's what the market is pricing right now.
In theory, like the way to describe it is the bar is really high for the Fed to go from like communicating that they need to go from 50 to 25, doing that, and then going back to 50.
Right.
Like that might throw their credibility into question a little bit. However, at the same time, like if they don't react to much hotter than expected data, and they're telling you that they're data dependent, right? Like, and there are tons of Fed members that believe in the sort of impact of front loading, which is just doing more of what you're going to do sooner rather than later. Yeah. Like then they would also go against their credibility if they don't go 50. So
it's crazy.
They're stuck. But Powell, yesterday was like, hey,
like we'll go 50 if we have to.
It's to the point where the data has to miss really badly between now and March 22nd or the next FOMC for us not to go 50.
Interesting. That's how he set it up.
That's how
he set it up
like
50's the likely outcome absent very different data.
And then the way to think about it is if he chooses to go 25 and the market's giving him 40 and he leaves 15 bips on the table, that's almost an easing of monetary policy in a way.
Right.
So,
which he doesn't want to be doing.
He doesn't want to be doing.
Yeah.
The other thing I'd be remiss not to mention is the historic levels of curve inversion that we have now just seen. We are talking about a 2s10s curve that has now broken 100 basis points. So I think as we sit now, we're at 107 basis points of inversion.
Explain what this is real quick for our listeners if they don't know the inversion here.
So essentially, what these curves measure is the difference between interest rates
at different durations.
At different durations. So the popular ones to look at are like 2-year versus 10-year, or 2-year versus 5-year.
Yeah.
Or 2-year versus 30s.
So when it inverts, now typically you're supposed to get paid more to hold debt for longer, right? That's the idea?
Correct.
And the opposite is true now. You're getting paid. Why is that?
It's a belief in the future path of Fed policy. So the market thinks that if you jack up rates to 5-6%, et cetera, what is that going to do? That's going to slow the economy down. That's going to slow growth down. That's going to slow investment down, right? And eventually the Fed will have to cut rates as a response to that. And so what the 10-year point is kind of telling you is that, the front end interest rate policy is not going to last forever. The Fed's going to have to cut things down, and that growth is going to be slower as a function of where the damage that front-end interest rate policy is going to do now. Mm-hmm. And it also has to do with, expectations of where long-run inflation are going to be, right? So right now, 1-year inflation break-evens are around 3.5%, and 2 years are around 3.5%. So the market's telling you, even though the Fed wants to get to 2% inflation, that it's only going to get to 3.5 with monetary policy
in the next 2 years.
Pricing
in what they expect from monetary policy.
Correct. Yeah. Which is like, if I was the Fed, it freaks me out a little bit because the market's telling me you got to jack rates to 5.60 and you still won't be at your inflation
you won't hit your
goal.
Target is what the market is saying.
Yeah, and now the market can be wrong all the time.
For sure.
But right now, looking at
it's the best prediction market we've got, right?
Correct.
There's no other real way to guess here. And then on the inversion, the level of this 2s10s inversion, because I saw some stuff about this. Some researchers were saying that like the other times that this level of inversion happened was like 1929 and the crisis in the 70s, and then also in the 80s right before Volcker did his thing. So very demonstratively, historically speaking, always precedes a major economic problem.
Yeah, correct. So it's tricky. At the same time, we have this issue right now because the economy is so hot.
Right.
Right? We're talking about historic levels of unemployment. 2 job openings per unemployed person.
That's crazy.
And prices that are still going up in the non-shelter services,
which isn't the same as the other times, and frankly, every time is different, right? You could have an exception to the rule.
Every time is different, and to be honest with you, there's a reasonable case to be made that the growth trajectory of the U.S. is totally fine. right? Just think about the kind of things that are happening, the structural things that have happened post-COVID, onshoring being a huge one of those things, right? You're bringing back domestic production into a really tight labor force.
Right.
And you've also just had like generally a lot of underinvestment over the past couple of years. I mean, energy companies are being like a big part of it. Like, what was the thing to do over the past couple of years? It was to take advantage of low interest rates. How did you take advantage of low interest rates? You issue a lot of debt and you buy back your stock, or you issue a lot of debt and you issue a dividend, right? Not necessarily reinvestment,
yeah,
right? And so the U.S., I think, structurally is headed towards a period of onshoring, reinvestment, et cetera. And now, will the interest rate sensitive parts of the economy slow down? Yes, absolutely. They have to. And just mathematically, like, homes will get cheaper if mortgage rates rise.
Right. Fewer people will buy them.
They have to. But that's not the whole economy.
Other stuff looks good, though.
Other stuff looks just fine.
Yeah.
And that's why, like right now, I keep struggling with this idea, like, are you supposed to be long interest rates or short interest rates? It's really tough. Part of me is like, can the U.S. economy really handle like 6% inflation, et cetera? And I really do think that a lot of the perception that the market has, and this is just kind of me self-reflecting, is just a function of just the environment we've been in for the past couple of years, right? I've never seen high interest rates in my entire career,
right?
For the most part.
Many people haven't.
Many people haven't.
Yeah.
I've also been, very U.S. focused. When you talk to anybody that is based abroad, especially in EM, they know inflation's a tricky issue. Like, I've seen it their whole lives. It's not something that just goes away.
Right.
And so I think there's a lot of like just bias in the U.S. that's just used to like low inflation,
right?
Low
and if it gets high, then of course it will have to come down.
Yeah, of course, because the economy will correct and blah,
that's
blah,
how
blah.
we do it here.
That's how we do it. But I think more and more as time progresses, we're like, holy shit, the U.S. economy is just fine with interest rates at 5% plus. However, I do think you are supposed to kind of realize that there are unintended consequences to monetary policy, and we are in uncharted territory with respect to certain things, and that anytime you raise the cost of capital from 0 to 6%, there are
something's gonna happen. Yeah,
right. If you're in the venture world, for example, or in the private world, I mean, you really like
it's hard.
Why are you taking the illiquid risk at high valuation
for like 10 years in some cases,
when you can get 6% on low duration stuff?
Yeah,
those business models are going to be fundamentally challenged, and also, basically business models that have lots of liabilities in the front end or floating liabilities, right? And one of the better examples is that I used to deal with a publicly listed company. Their whole business model was finance in the front end and buy assets in the back end, and all of a sudden, they're totally underwater.
It's like reversed.
It's reversed.
Yeah.
And if you think about it, like the Fed's balance sheet right now, that's exactly what it is. They have these liabilities, which is they got to pay these banks, interest on excess reserves. What are interest on excess reserves? That's going to be, top of the band.
It's really high.
Right? And what do they have on their balance sheet? A ton of assets.
Like long duration assets paying less. Yeah,
exactly. I think the average duration of the Fed bond portfolio is probably like 6 years, 7 years, something like that.
But they've got overnight rates to pay people.
They've got to pay the banks.
Yeah.
They got to pay the banks on all their excess interest. And so that's how you become insolvent.
Yeah, something's got to give, ultimately.
But luckily it's paper losses.
And currently right now you're saying it mostly looks okay in the economy. If it not even maybe okay, maybe even great.
Everything looks
jobs,
fine.
People have jobs.
Here's the other risk.
Real wages are still like below inflation, right? I mean, they're
yes, real wages have not
wages
been keeping
have grown.
Yes, they have. But here's the thing. So it's different. Like, you have to think about it like from what time period, because I think the wage growth has been a recent phenomenon,
right?
Versus like there were periods where folks were just not getting raises to keep up with it. Well, there was no inflation, so there weren't no raises. So you really have to focus on right. the time period. But yeah, I mean, 100 million Americans, because of the Social Security cost of living adjustments, they just got a raise, right?
Mm-hmm.
And that's not necessarily wages, but it's
money in your pocket.
Money in your pocket.
Right.
I
saw a lot of the unions have negotiated significant raises.
Absolutely.
Like I saw the airlines are
yeah.
So there are a lot of people who are making more money too. So, but I just mean to bottle that all up. Like you said, like there is structurally a lot of structural positivity in the economy.
Yes.
And it appears at the moment to be bearing these rates.
The other risk I think is really important to highlight is you have a nation of 1.3 billion people that is just reopening.
I know, China.
Powell is being asked about it, but there are huge risks to the commodity complex.
Right.
Like, God forbid oil starts spiking again, and all of a sudden people are like, wait, gas prices are up, and there's a pass-through feedback loop of energy prices into the prices of everything. Yep. And then
not to mention oil is a component in many other materials, right? Like
absolutely, plastic, like all of the above, and so there's still upside risks.
This is such a tricky, man.
Oh my God, it is.
What's it feel like? I mean, you're not like you've been in markets a long time, but not for decades.
Yes.
So, and like you said, your whole career has been in a low interest rate environment, along with basically anyone who's worked in the last 15 years.
Low interest rates and low vol. This is very different.
This is a very different, tricky environment.
Absolutely. I think
is it more fun?
It is really fun.
Like just as a trader,
as a trader, it is
so
more
much
fun,
interesting stuff
but you
happening.
Just have to it's just so dynamic that you just have to adjust your risk, right? Like trading 10K of DVO1, 3 years ago is very different than trading 10K of DVO1 now. Like when the stuff moves 3 times more, you got to be taking a third the risk. Right, and so it's very dynamic, and it really keeps you on your toes.
Yeah, love it. Beimnet Abebe, Galaxy Trading, as always, my friend. Thank you so much.
Pleasure.
Let's go to our friend Christine Kim from Galaxy Research. It's been a little while since you've been on the podcast. Great to have you back, as always.
Thank you, Alex. It's great to be back.
Yes, and so we're going to talk about a couple things, but you were let's start with ETHDenver, this giant conference that happened last week. You were there, you spoke at the conference and moderated a panel. What's your big takeaway? I mean, it looked like a pretty big conference on Twitter.
Yeah, I was so impressed with how massive the conference was. They switched from the Sports Castle venue to the National Western Complex venue, which is actually a venue for cattle and ranch and to showcase livestock.
Wow.
So they filled every square footage or every square feet of this massive barn almost.
Wow.
With a bunch of crypto people, and there were 5 different districts. They had all the DeFi booths in one area, all of the infrastructure development in another area. So I was really impressed with the scope of all of the conversations that were happening. It's like they touched on every single aspect of Ethereum, protocol development and app development.
So did this feel like, I think the last one that you went to was Devcon, which is the more developer-focused conference, and it was in Bogota, Colombia this year. That was 6 months ago. How is this different than that?
Honestly, the nature of the conversations were pretty similar. I felt like after Devcon, it was right after the merge, and so people were still really enthusiastic with how successful that was, and they were looking ahead to, okay, what's next? I think there's still a big question mark about what's the big narrative on Ethereum. And at Denver, you could see a lot of the same mini narratives around ZK EVMs, the roll-up future, what we're going to do about MEV, what's after the merge. So I think there were just a lot more of the same discussions happening at ETHDenver.
But the composition of the conference, right? This is a little bit more of an exuberant community conference as opposed to a developer-focused one, right?
Yeah, Devcon was much more focused, I think, on protocol development, whereas ETHDenver,
It's had big tent Ethereum. Everyone's invited. Yeah.
You had the VCs, you had all of the dApp developers. It was quite massive.
Yeah. And it was fun, right? I mean, I saw some pictures of parties and stuff, people dressed up in funny costumes. Obviously I saw the I'm not going to say cringy, but some people said cringy opening singing stuff. Were you at that?
No, thankfully I skipped out on that.
It was better than past years. I'll give it to him, though. Some of the past songs have been even worse, but this one was kind of funny. But anyway, it seemed like a fun, lively time.
It really was. I think the events that were happening were quite. It made me feel like we weren't in a bear market. It was people were completely back, just spending all their money on these events and hosting these events. It was a good time. It was a good time.
And okay, so I want to pick up on a thread that you mentioned about the sort of narratives that between Bogota and Denver. the big topics of the day, right, for Ethereum. I mean, obviously, we thought the merge in Shanghai, which, I would say formally completes the merge, right, by finally, it's sort of the last piece of the puzzle for the specific merge and switch to proof of stake. But was that like the main thing that people were talking about, or these other big issues, right, like privacy, decentralizing, block builders, MEV, et cetera? Like, have we made progress since Bogota? Like, it's been about 6 months.
I think there's been incremental progress, and surprisingly, yeah, the focus wasn't on Shanghai. The focus wasn't on staked ETH withdrawals. Everyone, I think, has already thought of this as, like you said, the last step towards completing the merge. It's the easiest step of completing the merge. There doesn't seem to be a lot of concern around sell pressure immediately after Shanghai. There doesn't seem to be quite a lot of concern around the technical risks around Shanghai. So the discussions kind of felt fragmented. Like if you're kind of a dApp developer in DeFi, you're searching for what is the next innovation in DeFi. If you're kind of like a MEV searcher or builder, you're thinking about the incentives of the MEV supply chain. So a lot of the events and a lot of the discussions I felt like were kind of siloed. But it just goes to show that outside of Ethereum protocol development, so much more is happening. And for Ethereum to succeed, you kind of need the input and the continued progress of all these other like collectives.
And there were a lot of them.
And it was really hard to keep track of like the incremental progress being done in each of them. And there wasn't like a big milestone that any of these groups had reached.
Right.
So I think I was kind of bouncing around thinking like, wow, Ethereum feels like a sprawling city.
Yeah.
Like it feels like you built a technology that has now created so much more innovation, permissionless innovation to happen on top of Ethereum. But unfortunately, it doesn't seem like, there's a clear path towards like incentivizing continued innovation in one area over the other, or like the success of one segment of the community over another. It just feels very discombobulated.
Everyone's just moving in a direction.
In some direction.
There's a lot of people.
Yep.
A lot of people building stuff.
Exactly.
A whole bunch of different ideas that are all getting built, basically.
Yeah.
And so not one cohesive narrative you felt like coming out of there.
Not at all. And I think that, one thing, though, I will say is there does seem to be this focus on more infrastructure development over app development of like, we can't build the super app on Ethereum now because there's no infrastructure to support it. Either wallet infrastructure or just the protocol can't sustain a high level of user activity, like it doesn't scale. So there does seem to be quite a lot of focus on if we're able to build the right infrastructure, like the right rails, then maybe that'll be the catalyst for what's next in DeFi, what's next in NFTs, what's next in gaming. So I did think there was more conversation still around infrastructure development than app development, but I know you hate that, Alex, and you're always like, we don't need better infrastructure, we need apps.
I mean, we may need both, but yes, it's usually like it comes down to this question about whether or not we're so early, right? People are like often, and not just in the Ethereum world at all, but across the cryptocurrency landscape, right? Long-term bulls are like, oh, we're so early. The Bitcoiners say this all the time too. And I'm just looking around being like, are we early? Or like, is it like, shouldn't we as a general ecosystem really be providing things people want to use, right? And when I look at the space, like I see Bitcoin as a global money. I see Ethereum as the dominant platform for smart contracting. And the apps that people like so far at scale is like DeFi and NFTs. And I really don't see anything else yet. And by the way, that's a lot. I mean, I think if you have Bitcoin, ETH, DeFi, and NFTs, like, obviously you have, and then maybe stable coins, right?
Mm-hmm.
But like, that's gotten us here. Like, I mean, I don't know, like, you can't just, yet another DeFi app to me is like not going to move the needle on global adoption. So it's not that I don't like infrastructure, and I hear this all the time too. There was a protocol that launched, and I talked to an investor in that protocol, and I said, like, what's the thesis here? And they're like, well, like there's all these apps that we need like much higher throughput to do. And I'm just sort of like, isn't that what every single protocol investor said literally over the last 10 years, right? Like, is this now, yes, it is what they all said. Maybe it's still true, right? And I think Ethereum, I mean, the hope here, I think, is that the roll-up ecosystem can be that.
Yeah, we'll be that catalyst.
Yeah. And so it's not that I don't want infrastructure. It's just that I sort of think like we need both. Maybe we need both. The argument was that like we can't get the killer app until we have the infrastructure to support it. I don't know if that's true.
Yeah.
But if it is true, then of course we need it. I just feel like there's been a lot of thinkery on blockchain design. And
There's
at some point,
thinkery.
Shout out to Walt Smith, I think, who created this word. And I think there needs to be apps that people want. And I feel like, a lot of effort has been put in on the blockchain design. And I guess there's been a lot of effort on the apps too. I guess I'm just asking a lot here. Someone make the killer global adoption app. I guess it's not that easy, but yeah. So they are building infrastructure though. The rollups well represented there, and people building stuff like that, all the ZK and
rollups were very well represented at ETHDenver. But again, because of the massive size of this event, they were just one small part of the collective of this mosaic of so many different groups there. Actually, now that I'm talking about this, the one group that I think was a little underrepresented in all of these topics was regulation. Every time I brought up, like what we think is going to happen to stablecoin regulation, what we think might happen to liquid staking derivatives.
Right. Not a lot of content
Not a lot
there.
of concern, really, from anyone I met about regulation, just thinking that regulators would eventually come to embrace the technology over time. But until then,
whatever, basically.
These,
to be clear, these are the builders.
Rather than permission.
Yeah, and these are the builders primarily. They're not necessarily the investors or the institutions primarily, right? This is more of a people building stuff in the Ethereum World Conference. So I guess it's not, you can still permissionlessly deploy software.
Yeah,
so
and I think
whether or not people are allowed to use it, I guess is a different question.
That too, and there's a lot more technology, I think, being built on Ethereum in a permissioned way, like creating web front ends that are only available in certain countries, interacting, allowing your technology to only be available to non-US customers, et cetera. Those kinds of So
there have been some innovations on that side of the, if we can call them that.
I don't know if we can call them innovations, but more so tiptoeing around the big elephant in the room.
Yeah. And remember, we wrote about OFAC when the Tornado Cash was sanctioned, and this was a big question for us as well.
Yeah.
And not even sort of just regulation, but the recent Oasis, what they called a self-counter exploit, where they used the multi-sig to upgrade their DeFi apps, such that they could then seize money from the wormhole hacker, which was like a week or two ago. That plus some of the regulatory stuff, did you get a sense that there's a strong, because you just talked about some of the more permission sort of solutions. Is there a turn in favor of more hardened, decentralized solutions as well? In your mind, was that a vibe that was there? We should, for example, not have admin keys or decentralize more, or an increased focus on decentralizing block builders or validators or whatever. Is that? I mean, obviously, is decentralization alive and well in the Ethereum mind share, or is it even accelerating?
I wish it was accelerating. I wish more people talked about what happened to the Oasis DeFi app. I wish more people continued to talk about the concerns around OFAC sanctioning Tornado Cash.
The implications of it. Yeah.
I wish there had been more talk around. There hasn't been a ton of movement towards making Ethereum more censorship resistant in light of all of these actions, in light of all these regulatory developments. Again, those kinds of conversations that I feel like some people tried to bring up at the conference were promptly struck down. I don't think it was
people just weren't interested in talking about
this. They weren't, and
yeah.
I think people were more focused on heads down building. Yeah, and I think it should have been a more important conversation. It should have.
Yeah, we've talked about this, you and I, about that. We think in general it should be an important conversation.
Yeah.
All right, let's move on a little bit. It sounds like it was a great time. Check out Christine's talk. You can find it on the ETH Denver YouTube page and the website. That was really good. About Shanghai.
Yes.
The forthcoming upgrade on Ethereum, where staked ETH will finally be able to be unlocked. There are people who staked their ETH on the Beacon chain in the end of 2020, I believe, that it's been there for more than almost 2.5 years without being able to withdraw it or the rewards that they've earned.
Mm-hmm.
That should come to an end with the rollout of Shanghai, which will enable withdrawals when?
Right now, the latest estimations are second week of April, early April.
For straight up mainnet activation.
Yeah, for
Yeah.
mainnet activation. Developers have made a ton of progress getting Shanghai ready as soon as possible. Honestly, I thought that it was going to be summertime by the time Ethereum got to its next upgrade after the merge. But developers have really been barreling through all of the test nets, all of the kind of preparations to get all the software clients prepared, ready for this upgrade. So the next big milestone in this like testing journey is the Gorley upgrade. That's the last public testnet that Ethereum developers are going to be launching the Shanghai upgrade on. And if that goes smoothly, they'll move on to mainnet. So Gorley is scheduled for, I feel like it's March 12th.
So it's soon. That's like
I
next
think.
week or the week after. Yeah.
I might have to double check my notes on that. But anyways,
in the next
they've
couple weeks,
scheduled,
though.
they scheduled the date. And from that date, you're going to assume that like developers give about 4 weeks until mainnet.
Got it.
Which is how we get the second week of April date.
Got it.
So Gorley, I think one interesting thing is that developers have been testing Shanghai on several different testnets before Gorley. And Gorley, I think, is less of a testnet for developers and more of a testnet for infrastructure providers, for staking pools, for staking as a service like centralized exchanges, for entities like Lido and Rocket Pool. I think developers are quite confident about the code, but the question is the community ready for this upgrade? Wallet providers particularly need to be able to update the balances of users for withdrawals.
Mm-hmm.
And the curious thing about withdrawals is they're not user transactions. They're like system level operations that happen. So you need to be able to connect to different API endpoints in order to correctly kind of like keep track of that activity.
Got it.
So Gorley, I think, is going to be a really important testnet for the community.
So, and you mentioned that we don't think there's going to be a lot of like ETH sell pressure. Christine and our colleague, shout out Kelly Greer at Galaxy, wrote a report about this.
Yeah.
What would Shanghai, I forget what we called it, what would Shanghai's like effect be on ETH USD? Where you did some of the math here and, you know, using various assumptions. Do we still think that's true? I mean, run us through what you thought about for that analysis, right? You've got staked ETH and then you've got the rewards primarily, right? These two pieces of ETH that they have.
And our conclusion and our assumption was that you wouldn't see a lot of people unstaking their ETH. And primarily because most of the ETH staked is still underwater. It's not, ETH price is a lot lower than it was when people had staked, around the majority of staked ETH. There's also liquid staking derivatives where if people wanted the liquidity, they could have traded off their staked ETH for ETH already.
If they were using Lido or something like that, right?
So for that and a couple other reasons, we had argued that we wouldn't see a lot of unstaking activity, but we would probably see Ethereum validators take some profit from rewards.
Yeah.
And rewards are really what's going to become liquid immediately at Shanghai.
So there's no queue, there's no exit queue or anything, right?
There's not a queue, but there is a limit to how many withdrawals the network can process at one time. They can't just withdraw like the rewards for every single validator in one go. It's like 16 withdrawals that are able to be processed per block, and every block gets processed in
But that's still
12
just
seconds.
a couple days, right? Ultimately, if everyone tried to withdraw all the rewards right away,
Yeah.
it wouldn't be like months. We're talking a few days, right?
Yeah. We're talking a few days. But that also, there's a little bit of a caveat there because some validators have to update their withdrawal credentials. They have to specify an address to which those rewards can be deposited. But the point is, there's about 1 million ETH that's going to be become liquid as a result
Pretty
of
quickly.
rewards. Yeah. And to find the number, like the percentage of rewards that we think are going to be sold, it's really anecdotal. We're talking to validator node operators. We're talking to independent home stakers. We're talking to people we know who have staked on the Beacon chain.
Say, what are you going to do with these? Right?
Exactly. And anecdotally, we're hearing a number between 30 to 50% of their rewards these validators just want to sell.
Yeah.
And the rest, you know, it's a mixture between restaking, putting it into DeFi, holding on to it. There's a variety of other kind of reasons for what they want to do with that ETH. So in our analysis, we conservatively estimated that 50% of rewards would be sold off like the week after Shanghai or throughout the week of Shanghai. So you will see a little bit of sell pressure, I think, immediately after the upgrade, but not a lot. And then I think you're going to see a ton more staking activity because now the kind of the uncertainty around when you're going to be able to withdraw your stake is removed. We're already seeing a ton of staking activity going into Lido. Lido experienced, the largest inflows of ETH ever a couple of weeks ago. And I think you're just going to see the staking rate, so basically the percentage of total ETH supply staked, dramatically
Which
increase.
is now
after
what, like
Shanghai.
14 or 15%, right?
It's at 15, yeah.
15%.
Yeah. If not 16, honestly.
And one other thing to mention, you said that you didn't think that there'll be a lot of actual unstaking of the actual staked ETH.
No, if anything, I think there's going to be more ETH staked.
Right, because
Yes.
some of the uncertainty is now removed.
Yes.
And when you mention the underwater, right, the price is a lot lower today than when a lot of the ETH was staked. I think it was like 60% of the ETH was staked at higher prices.
Yeah, exactly.
What's the idea there? Is it that like you don't have to sell, you don't have gains to realize? So if anything, you have losses to realize, but also you were early. You're probably an ETH bull, so
Yeah. I think if there had been
you'd
quite
be
a
a
lot
forced
of
seller. To be selling at these low levels, you'd have to be like in significant distress.
Which,
the idea.
with liquid staking derivatives today that are trading almost on par with ETH, like if you were a forced seller, there are ways to sell your ETH.
But like people who stake during beacon chain only era, pre-unlocks, pre-unstaking, like they're long-term ETH bulls, right?
Yeah.
So they're not like, oh crap, get me out of this ETH position. Much less likely to be so than say just a normal person.
Right.
That makes sense.
This bear market is kind of a blessing in disguise, because if we were in a bull market and ETH prices were a lot higher, I think there could be a lot more reason to sell now.
Right. So then the staking participation rate, you think it'll go higher because it's de-risked a bit once Shanghai happens. Also, right, when we look at other proof-of-stake networks, they have significantly higher staking rates than ETH, right?
Yeah.
Do you think it'll get that high to like 50%?
Well, not immediately, but you talk about this all the time, Alex, that as a proof of stake, in a proof of stake blockchain, if you're not staking your asset, you're essentially being diluted out of your holdings. And with liquid stake derivatives, I don't know why anyone would hold their ETH and be diluted out of their out of ETH when you could stake it and still have the liquidity of that staked asset. And so I think it doesn't make sense for the staking rate of Ethereum to stay low. I think the easier the more adopted liquid stake derivatives become, you're going to see. There's no reason not to have 100% of the stake.
I mean, if you trust the LSD, the liquid staking derivative token, trust it, right? Like, I don't know, it's decentralized enough or whatever. Right. Shouldn't you just be staking everything and then only using staked ETH for everything?
I think that
you can't pay
is
for
the
gas
end
and staked
game.
ETH, though, right? So you need ETH for gas, but then ETH
true.
really becomes this like,
But there's got to be some
staking
kind
and
of
gas
protocol.
token, basically, right?
Yeah.
And everybody else uses like staked ETH.
Also, one funny thing when I said that there wasn't really a lot of regulatory talk, a lot of people corrected me for saying liquid staking derivatives because of regulatory concerns. Like now, we call them either liquid staking tokens or liquid staking receipts.
Oh, they don't like the idea.
Derivatives is a taboo word now.
I mean, it makes sense. Obviously, derivatives are financial instruments, but it's funny that they like,
as a political correctness.
Yes, I mean, yeah, they and it's funny because actually this happens all the time.
Yeah.
So you have like real world assets that people talk about tokenizing, bring on chain like MakerDAO, right? And they call them RWA, but that already exists. That's risk weighted assets in traditional finance, right? So and they don't mean like derivatives like they mean in financial instruments. They mean derivations. They mean that these tokens are derived from from staking, right? They're liquid derivations.
Yeah.
So it's like they weren't wrong, but I get that sensitivity. I would say they're not like forwards. They're not like financial derivatives. They're really sort of like they are more like receipts.
Yeah.
They give you rights to staked ETH. Like so it's a little different. That's funny though. Okay, so along the same lines, we were talking about staking rates. Like there was news, I guess we've covered this in the past when it was first announced, but I guess in the last day or two, this institutional staking project, which I think used to be called Alluvial, it now sounds like they call themselves the Liquid Staking Collective, but it's some kind of partnership involving Coinbase and I think Figment.
I think so.
And something else. They announced their own liquid staking token.
Yeah, I think
yesterday.
Yeah, when we covered this, the interesting part of this was that it was targeted towards institutions. There hadn't been a lot of liquid staking as a service back in 2020, 2021 that was targeted away from retail towards institutions, mainly because institutions didn't really want to stake on Ethereum at the time either. Planning for the merge was a little bit chaotic.
Yeah.
There were developers were going back and forth, like how we're going to actually transition this thing into proof of stake. You weren't able to withdraw your stake at all.
But I mean, it was mostly like, the guys from Bankless and like Anthony Sassano, it was like long-term, like technically savvy ETH bulls. Vitalik was staking back then, right?
There wasn't a huge, I think, customer base
Right.
or appetite for institutional staking. But now take the announcement of the SEC cracking down on Kraken, calling their liquid staking program, like basically shutting down their liquid staking program. I think with Shanghai coming up, Shanghai de-risking a lot of staking activity on Ethereum, now suddenly there is a lot more appetite for an institutional grade staking solution. And that is why I think we're seeing the announcement from Coinbase. I think that's why we're seeing more progress on the Alluvial project.
Because we haven't heard anything about it in like 6 months. I think
we
I don't have the
haven't.
episode number, but we talked about this on Galaxy Brains, I think last summer, so summer 22, and then we really haven't heard anything about it since then. But
Until recently, yesterday.
Until yesterday. So we have to assume there's been real progress, but also you're saying the timing of the announcement makes sense.
Yeah, and I think it's interesting to question how Coinbase is going to square a staking service like Alluvial or the one from the Liquid Staking Collective with the staking service that they already have, which is geared towards retail, and the potential that their retail staking service could be scrutinized by the SEC.
Right. We're not going to go deep into this topic necessarily now, the Kraken and the staking as a service, but Coinbase notably has pushed back heavily. It said that their program doesn't look like Kraken. So
right.
And I don't think we've heard any news since that. So as far as I know, you can still stake on Coinbase your Ethereum, and they have their own liquid staking token, CBETH.
Yeah.
So this is also interesting. So this will be like a institutions only liquid staking token.
Well, I
or
think
something?
only the institutions can be the node operators for this staking program. I'm not 100% sure if the holders of the liquid staking token also have to be institutions. I think they have to be, at the very least, be KYC'd and AML'd.
It's interesting. So
it
remains to be seen how the announcement of this institutional staking as a service provider will have its own liquid staking token.
Yeah.
Remains to be seen what that means exactly, but interesting nonetheless.
Yeah.
It's also funny because like a lot of the other coins have staking as a service and stake, and they don't have a Shanghai. Most of them you can already enter and exit the staking. Validators can enter and exit the network. Right. It's really the Shanghai question is an ETH question only. Right. So that's the other thing I think about when I think about Shanghai and unlocks is like how does this affect the general like economics of Ethereum? Right. We don't like at scale. Right.
Well, yeah, it's going to stress test a part of Ethereum's economics that have never been tested before, which is the ability to withdraw your stake, the ability to fully exit from the network. And to be clear, like validators on Lido, validators on Rocket Pool are not able to unstake. People can't actually redeem their stETH for ETH right now. And so there are certain smart contracts that will be tested for the first time on Lido. Lido V2 is a big upgrade that we saw just a couple days ago. They had an unknown bug in their withdrawal contracts for Stakematic. So these are big. This is tech that needs to be tested. So I am very interested in how the unstaking activity will go, and I'm also interested in seeing how the bifurcation of the liquid staking market between permission, KYC, AML participants, and not will also then trickle into, say, a bifurcated or fragmented DeFi market on top of these two existing, say, liquid staking derivatives. Well, I shouldn't say derivative, but receipts. Because at the basis of what staking does is it allows like for a risk-free interest rate on your ETH. Then on top of that, you can start to create other financial instruments.
It's very interesting.
Yeah, but you have to make sure that the underlying asset is kosher, is like solid enough that you can build these other financial instruments on top of.
A lot happening and a lot to be seen in the next month or so too with Shanghai. Will be very exciting, I think. And I mean, it will really close a chapter. This is the completion of the merge when it happens, which is, I think we all agreed was probably the biggest, protocol development story of 2022, right?
Yeah, until developers decide to change it again.
Christine Kim, our friend from Galaxy Research, thank you so much as always.
Of course, my pleasure.
That's it for Galaxy Brains this week. Thank you as always for listening. Hey, make sure you check out our content, galaxy.com/research. Tons of reports there, and follow us on Twitter at GLXYResearch. We're always tweeting out some interesting stuff about crypto. But that's it. That's all we've got. We'll see you next week. Have a great weekend. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXYResearch. See you next week.